Well, good morning, Todd Williams. How are you today?
I'm doing great.
All right, and you are with Hamilton Point. You've been a great sponsor with us. Been taking good care of investors and clients. Been very responsive. So I appreciate you making the time today. Could you jump in a little bit? Tell us background on yourself, background on Hamilton.
So we are an apartment owner operator. We've been sponsoring investment funds, working directly with financial advisors around the country since about 2010. Although I think the genesis and the idea behind Hamilton Point came about in 2009. The two gentlemen behind the firm, their names are Matt Sharp and Dave Kelsey, and they had spent the majority of their early career working for large commercial banks. And when we entered what we now call the Great Recession, they felt that there was an opportunity to buy some distressed assets, during that time, back from some of the very lenders that they maybe had worked with, or at least had friends that continued to work there. And so that was our start point. As of today, we're raising capital in our 15th investment fund. We've also structured a series of DST investments, which are made available. It's a structure that is made available to folks doing a 1031 tax exchange. We currently have an offering available as a DST as well. But we're well known for our longevity in the industry. We've been doing this now for 15 years. Our track record for performance. And we'll get into a little more detail as to the company, its background, and the various investments we've put together over the years. As for me, this is probably my 20th year in the business. I've been working with Hamilton Point for the last 10 years. I'm an attorney, graduated law school in 1998, had my own law firm for a period of years, focused for a period of time on real estate. Working with, commercial brokers, mortgage brokers, regulatory agencies, all that fun stuff. Decided at some point I wanted to be on the other side of the aisle, the income side of the ledger versus the expense side, and made the leap into commercial real estate back in the early 2000s. So I've got a long and tenured history in this business as well. And you and I have known each other for quite a few years. So I'm very appreciative that you gave us this time to speak with you and some of your clients.
Well, you bet. Well, it's fun. You go to ADISA and some of the industry events of, FactRight or MIC or whomever. See all the same faces, but they're all, every couple of years they're wearing a different polo shirt, the different logo on it. But you've, been where you are for a while. So I love seeing the consistency. That's one of the things we really look for is track record with our sponsors.
Yeah. Me too. I hope I don't ever need another business card. In fact, my intention is to retire from this firm at some point and hang up the briefcase,
There you go.
as you will.
So now you weren't always exclusively in multifamily. Didn't you have a stint with student housing at some point in there?
Yeah, and maybe I'll go into a little more detail when we kind of go through our track record. I've got a slide that'll help me do that. But, there are different points in a real estate cycle, just like the stock market tends to have a cycle, the real estate market has a cycle. And I mentioned that, we kind of entered the space raising capital from high net worth investors in 2010. And at that point, we were on the backside or the downside of a cycle. We made our way through a recovery, and then we saw some further impacts to the real estate cycle that started in 2020. And then we saw the market peak really in 21 and 22. And really, if you look at it, the peak of the real estate market was in August of 2022. And we sold a lot of property at that time, so we took good advantage of that. But we did not want to buy into that same, market frenzy. It made sense to sell at those prices, didn't make sense to buy. And so we started looking around, and COVID uniquely impacted student housing, particularly starting in 2020. And then, universities stayed closed for a bit longer than necessary. So we took advantage of that and started buying student housing, kind of starting in 2020, and then did so all the way through 2022. while it was, more or less on sale or distressed. Today, those portfolios have bounced back quite nicely. We are selling those, so we're kind of exiting the student market, bought at the bottom, selling at the peak, which is kind of our goal.
Which funds were those in?
So that was fund. So student housing was a little bit in Fund 8, most of Fund 9, and maybe a property or two in Fund 10. So you guys might have caught a little bit of the tail of that in Fund 10. And then also, and this just kind of shows the willingness to be nimble when the market shifts or when opportunities appear. But also in 2022, as the market was peaking for multifamily, there wasn't a lot of cash flow available if you were to buy at that time. And so we decided to bring out a fund for manufactured housing, mobile home parks, because they sold at higher cap rates, better cash flow to the investor, and figured we could take what we do in buying and improving apartment properties and deliver that same impact with manufactured housing. So we brought a single fund out. It was Fund 11 in 2022, and we bought a series of, I think it was 11 to 14 mobile home parks that we are still to this day making improvements to, adding pad sites, buying mobile homes, making them available for lease or for sale. Kind of a value add type program for mobile homes. We're a couple years into that. We may do another mobile home park fund. It's kind of yet to be determined. But those are really kind of the two deviations. I would say the third is during COVID, we brought out a distressed hotel fund.
Okay.
Because
Well,
COVID very.
I was going to ask you about the mobile home park. Those seem to be a wonderful story there. Just, I know those aren't available right now, but 40 years ago, undesirable areas that are now very desirable. And the whole NIMBY, not in my backyard, they're not making a lot of them, and they're pretty economical places to live too. So do you see, are they regional where you have them, or when you've had them, have they been all over?
Yeah, so we bought primarily in the Southeast, kind of between Texas and Florida, although neither are in Texas and Florida, but I use those two states to kind of bookend the region there. Smaller market, certainly, you can look at it from a couple different perspectives. The first being affordable housing is an issue everywhere, right? We hear about it. It's quite expensive to build. Folks do need a place to live. When you look at mobile home parks, you brought up the fact that nobody wants them in their backyard. They are difficult to build and get approved, which means that the amount of mobile home parks is somewhat finite. There's about 43,000, mobile home parks in the United States. That number neither grows. Sometimes it gets trimmed a little bit as land is more valuable for other purposes.
Mm-hmm.
So we like that from the perspective of you're not going to see a lot of new supply added that starts to impinge on your ability to lease. But what we like most about it is, when apartments were trading at, let's say 3% and 4% cap rates, meaning the cash flow, if you paid all cash, was in the 3 to 4% range. Small mobile home parks were kind of traded amongst individual investors, and the cap rates were a bit higher, sometimes in the 7% range. And so we know our investors are sensitive to both cash flow and the ability to create appreciation over time. And so, we could buy them, produce a good cash on cash return. And then also, a lot of folks that own these aren't putting money back into the parks. And so we looked at it from a couple of perspectives. One is if we improve the park, we may be able to improve rent. But also, there are large institutional buyers that if we can aggregate a portfolio and then bring that park up in kind of appearance and operation, then we may be able to sell at a lower cap rate to an institutional buyer. So we're looking for some cap rate compression through an institutional sale, but also increasing the net operating income by adding things like pad sites, maybe amenities, bringing our own mobile homes into the park to sell, that type of thing.
Well, that's interesting. I know you don't have those available right now, but just how you demonstrated to be nimble from manufactured housing, student, mobile home, and the real focus right now then is in the 200, 300, 400 unit apartment complexes?
Yeah, I'd say that's kind of our sweet spot, kind of the 250, could be plus or minus. Haven't really seen us buy anything larger than 250. So, the inception of Hamilton Point 2009, as mentioned, we've structured 14, 14 funds. We're now offering our 15th fund. We've structured 9 DSTs. First and foremost, out of those first 14 or 15 funds, the first 7 have gone full cycle. So our 2010 through our 2019 funds have raised capital, deployed that capital, managed the real estate, produced income to the investor, ultimately liquidated the real estate profitably, and returned capital and profit to the investor. That's what we mean by full cycle. You have your money back, you have the profit, and we know what the annualized return is. So,
and the return of capital happens. The return of capital happens coincident with the liquidation, right?
correct. Yeah. Once we start selling assets, we start returning capital to the investor, along with the hopefully appreciation. In our case, it's always been appreciation. And then, once the fund is completely finalized, we can go in and calculate a total return. So, as mentioned, our first 7 funds have gone full cycle, as have our first 7 DSTs. Right now, we are sitting with an average annual return, or IRR, to the investor of 18% when you spread that across all of them. If you look at just the funds alone, it's 18.3. And since our humble beginning, today we've acquired well over 35,000 apartment units throughout the Southeast. Represents a total acquisition value that exceeds $3.5 billion. We're still considered a relatively moderate-sized operator. There are larger operators out in the marketplace, and there are certainly smaller. But we're well known in the markets that we are active in, which means that the brokers in those areas, when they do have a property that they think fits our profile, we see just about everything that touches the market where we're active. So I don't want to.
Are most of your properties what you'd be looking at as a B property or an A grade property? Do you get them as a B minus and value add to B plus, or how would you categorize that?
Yeah, in today's opportunity set, we are buying primarily new construction, Class A, in high growth markets, and we're buying direct from builders that are impacted by the rapid rise in interest rate, that are forced to sell at a time where they'd rather not.
Do you only buy stabilized properties, or do you complete some?
They're all completed. They may not be fully stabilized from an occupancy standpoint. However, most of them are.
Excellent. All right. Yeah. How many, what's the size of the typical fund, and how many properties do you usually have in it?
So a typical fund for us is going to be a 200 to 225 million capital raise. That capital raise takes 1 year for the most part, about 12 months. That works because, as we raise capital, we buy assets. So kind of raise for a month or two, buy another asset. And that time frame works fairly well for us as well. Meaning, if somebody handed us $200 million today, it would take us quite a while to deploy it. But if you can deploy it as you raise, that tends to work out. And, the previous fund took 12 months. We raised just a little bit over 225 million. So that's our normal size.
So which funds are open right now that are still deploying capital? Just 14, or how about 12?
Yeah, so Fund 12 is fully deployed. Fund 14 has really one more property to buy. We've got a couple of active offers out. We expect to have the final property under contract, in the next maybe 20 days or so. We just started raising capital in Fund 15, so we don't have an asset, nor do we have enough capital in that fund to purchase the first asset. But I would expect, maybe by the end of this month, you might see 2 properties under contract, the final property for Fund 14 and the first property for Fund 15.
And as a financial planner working with, a lot of retirees, but people of all ages, we love both the income and the growth model, what you guys are able to put out there. And that's been consistent for quite a while, right? That you're throwing I think pretty much about a 6% yield. So it's current income plus then the growth on top of that.
Correct. So in our current fund, as most of our previous funds, the distribution is really based on where the market is. So in the current fund and in the last probably two or three, the distribution to the investor is 6% annualized. That's paid in quarterly increments. So an investor with $100,000 investment can expect $6,000 per year broken up into 4 equal payments. The goal in this fund, as well as our previous fund, is to achieve, when everything is said and done, a 14% or better overall return. And that is made up of both the 6% current pay and then hopefully appreciation capital back at the end of the fund.
I think that, well, certainly we'll have, after this, we'll have a link below with the slides and all disclosures and everything so people can get more info, not only on the one that's currently open, Fund 15, but I think we also have a DST that's open right now, and we'll have some info in there for that.
Yeah. So I'll quickly depart and talk just a quick moment about the DST. The DST we have available is a single asset. It's a property in Hattiesburg, Mississippi. Hattiesburg is kind of a university town. There are 2 colleges there, kind of a small submarket. We like that because those smaller markets didn't see much new construction over the last period. There's no planned construction, but demand remains fairly constant. The newest property in that market is 2017. Our property was completely gut renovated in 2018, so we're offering really the newest units. So the property is called Tremont at 22. It is a property that was built in 2008 to be specifically student housing, meaning it was 4-bedroom, 4-bath units. It was underutilized, and so a group came in and bought it in 2018, and they completely gutted the interiors and recut the property into 1, 2, and 3-bedroom units. So it's now a market rate apartment, although still a certain percentage, about 15% of our tenant mix there are students. The remainder, singles, couples, could be young families as well. The property's basically been at about 95% occupancy for the last several years, which is great, showing that consistent demand. It's seen, 6% rent growth or NOI growth over the last couple of years, which is kind of twice what we would expect or would underwrite. So the property's been a really nice performer. And it's made available for folks that are looking to find a replacement property that are doing a 1031 exchange, so they can exchange out of a property that they may be tired of managing, buy a portion of or whatever they need to buy. So if they have a $200,000 need, they can accomplish that. If they have a $300,000 need, they can buy as much or as little as they need. It has a 4.55% starting cash flow. Okay. Goes up by about a quarter point a year. We've got 10-year debt on the property. We don't expect to necessarily hold it for 10 years, but we do want longer term debt than we expect to hold because we don't want to be in a position of being forced to sell at year 5 if year 5 looks like a poor year to sell.
Sure. Is that interest only for 5 years then?
It's interest only for the entire loan term.
Okay. And then what is the leverage on it?
About 47.3, I believe, somewhere right around there, 47.3.
Very good. Can you give me kind of an overview where you see the market going? You said you've see it doesn't repeat itself, but it rhymes, I think.
Yeah, I think earlier you asked me where the market is today, which is also important. As mentioned, student housing has recovered. It's being sold. All of our student housing portfolio is being liquidated. And so, Fund 8, which was our 2020 fund, has sold 8 of the 12 assets that it bought. Our investors have 100% of their capital back from, distributions and sales. We've got 4 properties remaining in the fund. All 4 are listed for sale. The broker opinion of value on those 4 is within range, to sell profitably. Hit a double-digit IRR for our investors in a fund that will be looked back on as probably the most difficult time to have made money. Let me show one slide here because I think this is going to show you the opportunity set, and then we'll talk about a couple of those acquisitions. So this one is the commercial property price index, and it's even been updated a little bit since this slide came out, but the information is no different. You can disregard the black line, take a look at just the red dotted line, and then the red unbroken line. The red dotted line just kind of tracks the trend, apartment value trends kind of smoothed out over time, kind of steady growth over time. And then you'll see the unbroken red line is really apartment values or what apartments are trading for. And so you can start to see that, kind of in the middle of 2020, maybe towards the end of 2020, apartment values started to, sell or trade for higher than their long-term trend.
Sure.
And this indicates not always anything bad, but when it gets really far, you get a big departure. That means possibly an overvalued situation. And you can see there too that the apartment market peaked quite a bit higher than its long-term trend average in kind of the summer of 2022. But interest rates were also increasing. And then by the end of 2022, they were twice what they were at the beginning. And you very quickly saw, for those that have to sell, if you don't have to sell, it's like a stock. You don't have to realize that gain, it might recover. But for those that had to sell, and that's usually anybody with adjustable rate debt, builders or others that find themselves in a position of needing to sell, they have to accept those lower values. Well, today, apartment values are trending about, maybe 15, 20% below their long-term trend. And for us, that represents an opportunity to buy at a cyclical low in the market while you're starting to see that little U forming there where, values are coming up just a little bit from where they reached their exact bottom. And for us, that's where we want to participate. That's what we think we've been buying into. And we're starting to see the green shoots of a recovery. You asked me if I could tell you where the market's going to be in 5 or 10 years, and this is being recorded, so I know I can't tell you. And boy, if I knew, I'd be a much wealthier man. But we do believe very confidently that we'll be selling in a better environment than we are today. Interest rates have already been reduced a couple of times. The Fed has signaled further interest rate cuts. That typically, just the way that interest rate increases drop values for apartments, the inverse should be true over time. You reduce interest rates, that should increase values. But also that large volume of new construction that began in 2022 has been completed, or for the most part will be completed by the end of this year. And then new construction starts are back to kind of 2009 levels. It's going to be a while before we see builders jump in with both feet again. So for us, that means that supply should become a little more static over the next 5 years. Sure. But demand continues to increase, particularly in the markets that we focused on. We've been buying primarily in Texas and Florida, the Carolinas. These are states where we continue to see people move to versus move from. We don't buy in California. We don't buy in New York. We buy where Californians and New Yorkers tend to move to when they've had enough. So as more people continue to move, as families continue to grow and demand, steadily increases, but supply does not, that puts pressure on rent. So the overall goal and belief is that over time, we should see over the next 5 years, rent growth, plus, interest rates coming down, cap rate compression. The combination of that should allow a profitable exit. Again, can't guarantee it, but that's what it looks like.
Well, there's two sayings that really drive the or are key to the success in the real estate market. One of them is that you make your money on the purchase, and you guys certainly have found that to be true. But also, you always buy with the exit in mind. And so you're talking about knowing you hit your numbers. You happen to exit at the top of the market, but you had a number in mind. This is what we need to achieve to be able to exit. So I think you've got that down. want to close by talking about two properties, just as examples, to review some of the recent stuff. Can you talk a little bit about the Willows at Grand Dunes? It looks like a great purchase.
That's our most recent property in Fund 14, and I don't know that I have a slide on it. You know, as to where we buy, this is where we bought historically. The last fund was focused primarily, you know, we ended up buying in Texas, Florida, and the Carolinas, not just for the reasons of supply and demand, but also, you know, if you're buying new construction from developers that have their back against the wall, you got to buy in markets where they overdeveloped, and that's Texas, Florida, and South Carolina. So you were looking for some examples, and so I'll give you a couple here, and these are recent. But to show you how quickly the market moves, this is a property we bought in Fund 12, actually, but it's right in that 2022, 2023 timeframe. And so, you know, we bought this property brand new from the builder, 97% occupied, not a distressed asset, but a builder that has to exit at a time they'd probably rather hold for a few more years, but they have an adjustable rate construction loan that has to be paid off once the property is stabilized. And they didn't build it to hold on to it. They built it to sell it, and they have to accept market value. So, you know, brand new asset, highly amenitized, well leased, nice submarket of Houston. And the reason we know we got a pretty good deal, the property across the street, literally across the street, was built at almost the same time, but it sold at the peak of the market. Wow. So they got lucky. That, you know, similar amenities, similar, you know, build type, similar rents, but a group came in and bought that property for $222,000 a unit in August of 2022. Our property was completed, let's say, and leased up a year later, and we came in and bought essentially what would be the same property for $182, or about $40,000 a unit less. Almost 20% below its most recent comparable sale. Now, said another way, if the market comes back 20%, they break even. We're 20% ahead or in the money. So, you know, that's why just how quickly the market moved in 1 year's time. We continued buying, you know, Fund 10 bought a few assets from builders. Fund 12, most of its assets, if not all, from new construction. Fund 14, all new construction. And Fund 15, the current fund, is expected to be the same. So we started executing on this strategy in late 2022, and while it's here, we'll continue to do so. But if you look at these price points as well, you know, this is a property in Burleson, Texas, just outside of Dallas, 90% occupied. We bought 4 or 5 assets from this same builder. So this is a prolific builder in Texas. And if you look at the price point, $187,000 a door. To put that in perspective, when we sold our portfolios in Fund 6 and Fund 7, those were 20-year-old apartments, Class B, that we had done some light improvements to. We sold them for an average of $160,000 a door. Now we're turning around and buying brand new construction for $185,000 a door. We think it would cost well over $200,000 a door to build it today. So they started this, you know, back in 2021, 2022. At today's rate, you know, for, you know, construction material, you know, finding skilled labor, we think it would go for, you know, at least $212 a unit, possibly $220 a unit to build. We've got comps in the market at peak of properties like it selling for $255 a unit. And we've got post-correction pricing comps at $212 a unit. We're in at $185. That was in the previous fund. And then, you know, we talked about Florida, and this is where stuff got real fun. Builder in Florida offered up 3 properties in a portfolio. We made an offer on all 3. One, as mentioned, was 77% occupied, 184, and then the other 90. They accepted our offer on the 2 that weren't fully leased up at $150 a square foot. Now, I don't know, Wally, what you can build around you for $150 a square foot, but
in Colorado, not a whole lot in Colorado.
No, average construction cost in California is $465 a square foot, not including land, and I always like to put it in perspective. If you could build an 1,800 square foot house for 150 a square foot, that would cost $270,000. It's hard to find that house in today's marketplace. But at 465 a square foot, that 1,800 square foot house, about $830,000, which is about the California median. So 150 a square foot is an amazing deal. You couldn't build it for that today. And we've already, increased occupancy. We've owned these properties for a bit, but the real interesting part of the story is the property that the builder had that was 90% occupied, they kept it on market thinking they could do better. They came back to us because we closed quickly. We closed all cash, I think. We bought, we closed in 30 days. We were easy to work with. And they came back a couple months later and said, you know what? We'll take that offer that you gave us, on the third property. And we knew they were hurting. And we said, well, that offer no longer stands, but we'll take that third property off your hands for $143 a square foot. Wow. So we bought the third property from them for $143. And that's kind of the range that we're working in today. We've got offers out in some properties in Georgia, but we're still looking in Texas, Florida. Austin's a little overbuilt, but Houston and Dallas. And if you look and kind of pay attention to the news, one of the reasons we like Texas, Florida, it's where we see both jobs and population. Apple's building, I can't remember how many billions or hundreds of billions of dollars of an AI plant in Houston area. Eli Lilly just announced a $6.5 billion plant to be built for their GP, what are they called? GP1, those weight loss products. Yeah. And it turns out that from really good luck, that the location they chose to build that $6.5 billion plant is walking distance to one of the properties we just acquired in Fund 14.
Okay. Very good. Well, I look forward to getting, if you can send me out the deck, the various links and things. We'll put a summary of this in the bottom so that visitors can take a look at it. It's a great track record. I love how you guys are right out front with the detail of your purchases, each one of the full cycles that you've done. That's super helpful. We will look to do this again about a quarter from now and get an update. We'll hear about what else has gone full cycle and take a look at what you've done with acquisitions in 14 and 15. So any closing remarks? Anything left to review?
No, the last thing I'll just mention, I just cycled through 3 slides, but folks that want more detail, either it's in the PPM, but we list out every single property that we've bought and sold over the last 15 years, what we paid for it, what we sold it for. And we're almost at the point where I think we've bought close to 180, 190 properties, closing in on that 200 mark. We've sold well over 100 of them, and you'll see some greater appreciation than others. But there's nothing hidden in our details. We have audited financials on the fund. We have audited financials on the firm. And I don't think you would work with us if we didn't. And, we didn't touch a lot on risk, but for anybody that's interested in the program, obviously they'd reach out to you.
Wow.
Well, you get a private placement memorandum that details all of the foreseeable risks, even though some of them may seem extremely remote. By law, we've got to do that. And then obviously, if you have questions, once you've reviewed that, and you can reach out to us, and we're happy to, conduct a call and make sure you get your questions answered.
You bet. You bet. Well, I appreciate it. It's been very informative, and I think you guys, the thing I like is you've got a lane. Even if you've changed the target property from multifamily to student, for example, you still have a model that you're running, and that has to do with buying well and knowing when your exit is right from the beginning. So enjoy working with you. You got a great team. You take really good care of clients we send your way. So, Todd, thank you for your time.